top 5 lessons after managing millions in 5 years as a property accountant. Recently, my accounting business, Accufy Accounting, celebrated 5 years in business. Okay, and during that time, I've had the privilege of working with dozens of different property investors. I've been able to get an unrivaled insight into what makes a successful property business. Okay, so from this insight then, I've been able to come up with 5 top lessons which you can take away and apply to your property business. Okay then, lesson number 1. Service charges can have a significant drain on your property cash flow. So for those that purchase flats as investments rather than houses, you're going to have to pay ground rent. You're typically going to have to pay ground rent and also a service charge. Now that service charge is paid by all of the leaseholders to the freeholder of that block. That money is compiled together and it's used to conduct maintenance and repairs in the shared areas of the apartment block. Now, typically in some of the more modern flats, these service charges can be very high. And the result of this is it can have a real dampening effect on reducing your cash flow. I think it's really important when you're analysing a deal just to assess the service charge and bring that into your overall numbers to see whether the deal stacks up. If the service charge is too high, it's going to drag your cash flow down, then maybe reconsider whether that's a good property to purchase. You might be better off looking at houses which don't come with service charges, assuming they're not leasehold, which most houses aren't. An even better tip is to, rather than buy a leasehold flat, look to buy the entire block. If you buy a multi-unit freehold block, then you are the freeholder. You're not going to have leaseholds because it's typically all on one freehold. Additional benefit is assuming that there are more than 6 units within the block, you can benefit from paying non-residential rates of stamp duty, which can result in a significant tax saving. So just be really careful if you're buying a leasehold flat, just to make sure that the deal stacks up. Make sure you you factor in the service charge into the overall profitability assessment of the property. If the service charge is going to bring your cash flow down too low, then move on and find a different deal. Okay, the second lesson then is that having a trading business that runs alongside a property investment can be a powerful strategy to grow your wealth. Where a property investor who has a job, they have to use after-tax pounds in order to purchase property, whether that's in their limited company or in their own name if they're a sole trader. This means they've clearly already paid personal tax on their income to then use to purchase property. An entrepreneur who has a trading business and then sets up a property investing business has an advantage. Rather than extracting salary and dividends from their trading company, what they can do instead is loan directly money across from their trading company into their investing company as an intercompany loan. This negates the requirement for them to extract any salary or dividends from their trading business. And it's a fast and straightforward way to put money from their trading business into their investing business to purchase property with. They could also look as a more advanced way would be to set up a group structure. So you'd have the trading business, the investing business, and then a holding company over the top. But a really straightforward and simple way is to have a loan from the trading business to the investing business. And I've got a video which I'll put in the description which talks more about the power of intercompany loans. Lesson number 3 then. Some of the most successful property investors have a really boring strategy. Okay, rather than being distracted by shiny penny business strategies, successful property investors typically plug away at their portfolio over a long period, purchasing units as they go along, often single units. Avoid shiny penny strategies and just focus on what they're good at, which is purchasing individual units. And over time, they can build a significant portfolio. Right, lesson number 4 then. The best investors know their numbers. They will have a system which enables them to track the individual performance of their properties at any one time. So the best way of doing this is with cloud-based accounting software, which is going to enable you to run bespoke reports which show the individual performance of your properties. Importantly, this is going to enable you to see which of your properties are performing well, so you can take informed decisions about your portfolio. And they're not caught out. They track their balance sheet, so things like their director's loan account, track that over time and make sure they don't come overdrawn, meaning they have to pay a tax charge. Okay, the 5th and final lesson then is that the best investors use debt to power their portfolio, but they use it sensibly. Okay, so they're not going to become over leveraged, going to borrow every single pound against their property so they can grow their portfolio. They're going to do it sensibly, have sensible loan to values, and once they've taken that initial refinance out of the property, they're going to leave that property untouched and not borrow further against it. Okay, the risk they're avoiding here is if you have a property which you refinance, if you continue to refinance, you may reach a point where actually the deferred tax liability, so the amount of tax you're going to pay when you sell that property, is higher than the equity in the property. And this is a dangerous position. It means that you have a liability on your balance sheet rather than an asset. The best investors don't over leverage, they do it sensibly. So just to summarise then, make sure you stack the deal to make sure that the service charge still leaves the property profitable, but even better, buy blocks or single units which avoid the requirement to pay service charges. And if you do buy a block, you can benefit from non-residential rates of stamp duty, assuming you have 6 more units in the purchase. Having a trading business alongside an investing business is a powerful way of growing wealth. Lets you loan money directly from the trading business into the investing business without having to pay personal tax to get it out of the first company. Best investing can be really boring. Don't get distracted by shiny penny strategies. Just work on building up your portfolio over time and compounding your returns. To be a successful investor, you need to know your numbers. You need to have a system for managing your property finances on a day-to-day basis, and you should be able to run bespoke reports which show you what your profit and loss for each property is and what your balance sheet is at any time. Cloud-based accounting is the best way to achieve this. Okay, and finally, use debt sensibly to grow your portfolio. Don't become over-leveraged and put yourself in a position where your deferred tax liability is higher than the equity in your property because you've over-leveraged. Got a video here which can talk you through how to manage your property finances using Xero.